There is an institution in Washington that you have probably heard mentioned on the news almost every week. It does not make laws, it does not run for election, and it does not answer to the president. Yet its decisions touch your mortgage payment, your credit card rate, your savings account, and the cost of just about everything you buy. That institution is the Federal Reserve. And right now, in the middle of 2026, it is at the center of one of the most consequential economic debates in years. So today, we are going to break it all down from the ground up. What is the Federal Reserve? Where did it come from? How does it actually control interest rates? And why does any of this matter to your everyday life? Let us start at the beginning. According to the Federal Reserve's own historical records, the Fed was founded by an act of Congress in 1913, and its primary purpose was to enhance the stability of the American banking system. But why did the country need it in the first place? The U.S. Senate Historical Archives explain that the need for a central bank became painfully evident during the financial panic of 1907, when the stock market collapsed, banks failed, and credit evaporated. Because the federal government lacked the tools to respond, it had to depend on private financial institutions to provide an emergency infusion of capital to keep the banking system alive. Congress decided that could never happen again. So on December 23, 1913, President Woodrow Wilson signed the Federal Reserve Act into law, creating a centralized institution designed to give the nation a safer, more flexible, and more stable monetary and financial system. Now here's where it gets interesting, because the Federal Reserve has a structure unlike almost any other government body. It is not a private bank, but it is also not a purely public agency. According to the Federal Reserve itself, it considers itself an independent central bank because its monetary policy decisions do not have to be approved by the president or by anyone else in the executive or legislative branches of government. It does not receive funding from Congress, and the terms of its board members span multiple presidential and congressional terms by design. The idea, according to economists and policymakers for over a century, is that an institution making decisions about the nation's money supply should not be subject to short-term political pressures. So how is it structured? According to the Federal Reserve, the system has four main components: the Board of Governors, which is a 7-member panel appointed by the President and confirmed by the Senate; the Federal Open Market Committee, known as the FOMC, which is the body that actually votes on interest rates; 12 regional Federal Reserve banks spread across the country; and the member banks themselves, which are the private commercial banks that participate in the system. The FOMC, according to the St.
Louis Federal Reserve meets 8 times a year to determine the federal funds target range. When you hear that the Fed raised or lowered interest rates, this is the committee that made that call. Now, what exactly is the federal funds rate, and why does it matter so much? According to the St. Louis Fed's own data portal, the federal funds rate is the interest rate at which banks lend their reserve balances to each other overnight. Think of it this way. Every bank in the United States is required to keep a certain amount of money in reserve. On any given day, some banks have more than they need, and some need a little more. They lend to each other for very short periods, usually overnight, and the rate they charge each other for that is the federal funds rate. When the Fed raises its target for that rate, it costs more for banks to borrow from one another. That cost gets passed on to you in the form of higher interest rates on mortgages, car loans, and credit cards. According to the St. Louis Fed, the federal funds rate indirectly influences longer-term interest rates, such as mortgages, loans, and savings, all of which are very important to consumer wealth and confidence. The Fed is also guided by what Congress calls a dual mandate. According to the Congressional Research Service, the Fed targets the federal funds rate to achieve its statutory dual mandate of maximum employment and price stability, which it defines as a 2% inflation rate. In plain terms, the Fed has two jobs at once: keep unemployment low and keep inflation under control. The challenge, according to CBS News reporting, is that those goals can conflict with each other. If the Fed lowers rates too much, the economy could heat up, but inflation could soar. If it sets rates too high to curb inflation, it could hurt economic growth and push unemployment higher. That tension is at the heart of every decision the FOMC makes. Now, here is the part that really matters for understanding where we are in 2026. The Federal Reserve has been on a dramatic journey over the last several years. According to the Congressional Research Service, monetary policy has whipsawed in response to economic disruptions. The Fed first reduced interest rates to near zero in 2020 in response to the pandemic. It then raised rates from 2022 to 2023 to a peak range of 5 to 5.25% in response to high inflation. Then, following some improvement in inflation readings, the Fed cut rates 3 times in late 2024. It then held rates steady for most of 2025, waiting to see how new tariff policies would affect the economy before cutting again in late 2025. As of June 2026, according to official Federal Reserve data and trading economics, the federal funds rate sits at 3.5 to 3.75%. And now the story takes a new turn. At its June 17, 2026 meeting, the Federal Reserve held rates steady for the fourth consecutive time.
But it was who was running that meeting that made headlines. According to reporting from NPR, PBS NewsHour, and multiple financial outlets, this was the first rate decision under a new Federal Reserve chair. The new chair was confirmed by the Senate and sworn in earlier this year, stepping into the role after his predecessor's term as chairman expired. According to Trading Economics, the appointment was initially viewed as leaning toward lower interest rates, but the economic environment made that path complicated. According to NPR, inflation is currently at its highest level in more than 3 years, driven in significant part by a wartime spike in energy prices stemming from the conflict in the Middle East. That has pushed rate cuts off the table, at least for now. Here is what the new chair did at that first meeting. According to U.S. Bank financial reporting, he held rates steady while simultaneously signaling a broader overhaul of how the Fed operates. He shortened the official policy statement dramatically to just 130 words, according to NBC News, down from 341 words at the previous meeting. He announced the formation of 5 internal task forces to review everything from how the Fed communicates to how it measures inflation and evaluates its own balance sheet. And according to CNN Business Reporting, he explicitly said the Fed had dropped what is known as forward guidance, meaning the Fed will no longer signal in advance where it thinks rates are heading. That decision, according to Citi AM, surprised markets and raised concerns among some analysts about transparency in a system that, as Citi AM noted, manages some of the most important and influential decision-making in the entire global financial system. The dot plot, which is the chart where each FOMC member anonymously submits their projection for where rates will be, told an interesting story. According to PBS NewsHour, 9 of the 18 officials who submitted projections indicated they could support a rate hike later in 2026, with 6 of those supporting 2 quarter-point increases. That is a sharp shift from just 3 months earlier, when not a single policymaker had penciled in a hike, and the committee as a whole had forecast a cut. According to CBS News, markets after the meeting were pricing in a better than 90% chance of a rate hike by October 2026. Now step back and ask the bigger question. Why do all of these decisions matter so much right now? The answer connects to the national debt. According to Treasury data reported by the U.S. Debt Clock, the national debt currently stands at approximately $39.3 trillion as of late June 2026. According to Fortune magazine's reporting, the government is already spending more than $1 trillion a year just on interest, more than it spends on the military or healthcare.
According to the Congressional Budget Office projections cited by Prime Rates, the federal deficit for fiscal year 2026 is expected to reach roughly $1.9 trillion, about 5.8% of GDP. And according to Fortune's analysis, the government is borrowing about 6% of the entire economy every year, even though unemployment is relatively low and the economy is expanding, a combination that, according to the same reporting, is historically unusual. Here is the mechanism that links the Fed to the national debt. According to Fortune and the Congressional Research Service, the national debt is not a single loan at a fixed rate. The government is constantly borrowing new money to pay off old loans and pays whatever rate the market charges on any given day. When the Fed raises its rate, short-term government borrowing gets more expensive. If rates on longer-term debt, the 10-year and 30-year Treasury bonds, also rise in response, the cost of carrying the debt increases substantially. According to Fortune's reporting, each 1 percentage point increase above current assumptions on longer-term debt adds trillions of dollars to the decade's borrowing. According to U.S. Bank's financial analysis, the new chair's first meeting signaled less forward guidance and announced a broader review of Fed communications, the balance sheet, and the inflation framework. The Fed's balance sheet, which currently stands near $6.6 trillion according to U.S. Bank, had peaked near $9 trillion in 2022. The new leadership has expressed interest in reducing it further over time, though analysts note that shrinking it too quickly can cause volatility in financial markets. What comes next? According to the Federal Reserve's own calendar, the next FOMC meeting is scheduled for July 28th and 29th, 2026. With 9 officials already signaling potential support for a rate hike, markets and economists will be watching closely for any new data on inflation, employment, and energy prices. According to U.S. Bank analysis, markets now lean toward the Fed increasing rates later this year, but inflation, oil prices, and labor market conditions can all shift that outlook. According to CBS News financial reporting, the chair will need to build consensus among committee members, a task analysts describe as complex in an environment marked by elevated inflation, geopolitical uncertainty, and a stubborn debt problem that economists say is not going away. Here is the takeaway. The Federal Reserve was built more than 100 years ago precisely because the country learned, the hard way, what happens when there is no institution capable of managing the money supply during a crisis. Today, that institution sits at the intersection of inflation, employment, national debt, and global financial markets. Its decisions ripple through every corner of the economy.
Whether you are paying off a credit card, applying for a mortgage, or simply buying groceries, the Fed's choices shape the conditions you are operating in. The next FOMC meeting in late July will be the first real test of the new leadership's direction, and financial markets, governments, and households around the world will be watching every word. Follow this channel so you do not miss the update when that decision drops.